you ever wondered how much money you could make by day trading futures? S&P futures give traders the possibility to earn a lot of money and at the same time limit their risk exposure. Hi everyone, my name is Numan Ashad. In this video, we are going to break down the topic of futures trading. To be very precise, we are going to discuss three major points today. Number one, what exactly are futures and how futures differ from stock trading and options trading. Number two, what exactly is the payout structure on futures? And number three, what exactly you need in order to start trading futures. So with that being said, let's have a deep dive. So the platform I'm using today is Thinkorswim. In order to open S&P futures, I'm going to write here ticker ES. This will open S&P E-mini 500 future contracts, right? So this is the price section, what you are seeing here. This is a 5-minute chart. Each bar is representing the price action for 5 minutes. Now, futures are trading at 4290.50. This is an overnight session as the market has not opened yet. So the most important thing for you guys to know would be what exactly is the payout structure on futures. So the payout structure on futures depends on the type of contract that you are trading. If you are trading S&P 500, the payout structure on futures will be different if you are trading the micro contracts. What do we mean by that? Let's have a deep dive. So the first thing that you would have to understand is that future contracts move by ticks. Each point has 4 ticks in it. What exactly we mean by tick? Well, a tick is just a 25-cent increment in price, right? What does it mean? It means that right now, for example, the price is 4289.50. Now, the price is not going to move by 55, 56, 57. The price is going to move by 25-cent increment. So the next price, as you guys can see, is 4290.25. Then it will be 4290.50, 75, and 4291. So the price moves by ticks, by 25-cent ticks, and each 1 point has 4 ticks in it. So this is the first most important thing that you guys should know. Now, secondly, coming to the payout structure, so depending on the contract that you guys are trading, you guys will get paid differently. So if you are trading S&P E-mini 500 contract, each tick is worth $12.50, right? What does it mean? It means that if S&P moves 1 point, you will be paid $50. Similarly, if the trade moves 1 point against you, you will lose $50. So that is the first most important thing to know. For S&P E-mini 500, for every point that the price moves, you will get paid $50. Now, there's a second type of contract, which is called the micro contract. And again, we are going to discuss these things in detail later on in this video as well. So what exactly is a micro contract? Micro contract works exactly the same way as a normal contract. The only difference in micro contract is the payout and the risk. What does it mean? It means that instead of getting paid $50 per point, you will get paid $5 per point. Why? Because the payout per tick, per 25-cent increment is different for micro or if you are trading E-mini. So that is the most important and the most crucial difference. So with that being said, let's summarize what we have just discussed. As we said, we can trade 2 types of contracts when trading S&P 500 futures. One contract will be E-mini, second contract will be E-micro, right? The symbol for E-mini S&P will be ES. For micro, it will be MES. So when you write in your platform MES, the micro contract for S&P mini should pop up. The minimum tick value is 25 cents for both of the products, which means that $1 has 4 ticks in it, right? 25-cent increment in price. The dollar value of 1 tick for E-mini will be $12.50, for E-micro will be $1.25. So the multiplier in here is 10. right? The total payout per contract is $50 for E-mini, and for micro S&P 500, it will be $5, right? So as you guys can see, the risk factor for E-mini contract is much higher than the risk factor for the micro contract. So if you are a new trader that want to trade futures, I think you definitely should start with micro contracts because you will have more control over your risk management. And once you are familiar with how futures move, then you can shift to trading the other product. Now, there is one thing which is different in futures when we compare futures with other products is the contract months. Future contracts expire 4 times in a year. They run by quarterly basis. So the 4 quarters, March, June, September, and December. And each contract has different symbols. For the March contracts, the symbol will be H. For June will be AIM. For September, it will be U, and for December, it will be Z. What exactly we mean by these letters? Let's go back to the platform. Let's try to understand at a deeper level. So as we discussed, when we write ES here, it is going to give you the futures price in general, the future price for S&P 500. But if I want to trade, I would have to open a contract, right? As we are in October right now, and as we discussed, the next expiry is in December, and the letter for the next expiry is Z. So what I'm going to write here is ES as for S&P 500, Z for December contract, 23 for year 23. And when I write ESZ23, it is going to give me the contract for the December expiry. Depending on the month that you currently are in, you select, for day trading purposes, you select the next available contract, right? So as said, right now we're in October, so for trading futures, we are going to select the December contract. So with that being said, let's quickly cover some other important aspects on futures trading, right? Just looking very quickly on the legal definition. This definition is provided by the CME Group. A legal definition of future contract, that's a legal binding agreement to buy or sell a standardized asset on a specific date or during a specific month. Now, this again is a legal definition. You really do not have to worry about all this stuff. All you need for futures trading is to have some money in your account, and then you go long depending on your long bias, or you can go short as well depending on your short bias. So with that being said, let's also quickly look at how futures differ from stocks. There are 2 major things that you need to think about when comparing futures with stocks. The first major difference in futures and stocks is that in futures, you don't really own anything. As we said, you simply have capital in your account, you go long or you short. You are not going to own anything. What exactly we mean by owning anything is that, for example, if you trade stocks, right, and let's say you buy ticker Apple and you buy 1,000 shares. Now, theoretically, you can hold those shares until infinity. There is no time pressure, right? You will be a minor owner in Apple stock, in Apple company, until you decide to sell those shares. You will maintain your little minor ownership. With futures, there is no such thing as ownership because this is an electronic agreement. You buy, you sell, and that's it. You don't really own anything, right? Second major point of difference in stocks and futures is that future contract expires. Shares of stocks don't expire. What do we mean by that? As we just discussed in here, Apple you can hold until infinity, but with futures you can't hold until infinity. Future contract expire every quarter, as we discussed on previous slide. So unless you decide to roll those contracts over, your contract will expire. And what do we mean by rolling over? Rolling over means that, for example, if you currently are trading March contract and March is approaching, you change your position to the June contract expiry. Similarly, if you have June and you want to change it, you change it to September. That is what we mean by rolling over. So that is another big point when we speak about stocks versus futures. And when we compare futures with options, the biggest difference with futures and options trading is that in options, you always have to worry about option Greeks. What exactly are options Greeks? As you guys know, you have to worry about the volatility. You have to worry about the time expiry, right? Time value of money. You have to worry about Vega and all those factors, because those factors affect your premium. With futures, that is not the case. In futures, there is no Greeks at all. In futures, you do not have to worry about your premium, right? As long as the price is trading higher than your entry price, you are good to go. You do not have to worry about Greeks at all. You do not have to worry about what the price does in between. What do we mean by that? Let's again go back to our platform and look at a live example. So for example, right now, let's say the low of the day, low of the overnight session is 42.82, right? And let's say that you take a position right here, right? So let's say you go long 42.82 and you put a stop at 42.81, right? And your target is 87. Just an example, right? Now, as long as the price is trading above 42.82, you are in profit, right? Does not matter what the price has done here. Does not matter if it is consolidating. Does not matter if it is chopping around or whatnot. It works exactly as the stocks. As long as the price is trading above your entry price, you are in profit, right? So in this case, let's say if you are trading S&P mini for those 5 points, right? As we said, each 1 point pays you $50. For those 5 points, you already made $250, right? Now, of course, if you have more contracts, let's say if you have 2 contracts, you will make $500 on those 5 points. If you have 4 contracts, you will make $1,000 on those 5 points move. So similarly, unless the price starts trading below your entry price, you do not have anything to worry about, right? Now let's go back to the options. With options, as you guys know, the story is slightly different, right? Let's say if you enter here and your price target is here and the price starts consolidating or the price starts chopping or whatnot, your premium is going to take a massive hit, right? So let's say even though the price does arrive to your target, the value of your premium will not be the same as it was before. It will get chopped up. Unless the market makes a very strong and straight move, option premiums will get crushed. So that is a big advantage when it comes to futures trading. So with that being said, let's quickly summarize the benefits and cons of trading futures. So the first major benefit of day trading futures is that there's no PDT rule. Those of you who actually trade, you know what exactly PDT rule is, but let's explain that very quickly. PDT rule says that if you want to day trade, you need to have at least $25,000 in your account. If you want to trade stocks, if you want to trade option, does not matter. You have to have a minimum balance of $25,000 in your trading account. Now, the pro of futures trading is that that rule does not apply. You do not need to have $25,000 in your trading account. Each broker in general has its own rules, but the leverage requirements are very small and the PDT rule does not apply. So for those of you who are thinking of getting into trading, this is a very good option because you do not really need a lot of money to start trading. The second major advantage of day trading futures is that you do not have liquidity problems. Future markets are very liquid. We have a centralized exchange. Having a centralized exchange means that each and every order that is placed for future trading pops up on our screen. So there is no liquidity problem at all. Liquidity is provided. You can get in and out within seconds. You do not have to worry about your fills. You do not have to worry about liquidity at all. The third major advantage of trading futures is that you do not have to worry about short selling allocation. What do we mean by that? Sometimes you probably have seen that you want to short a stock, and when you go on your brokerage and you hit the short button, you get a message saying that the shorts are not available on the stock because the brokerage does not have it. Now that is not the case with futures trading. As said, as long as you have money in your account, you can go long or you guys can go short depending on your bias. You will never get an error from your brokerage saying that short allocation is not available. You can short, you can go long depending on your conviction, depending on your hypothesis, depending on your trade setup. So you do not really have to worry about getting filled or not getting filled at all. And the last major point when it comes to the benefits of futures trading is the lower margins. That is something we already sort of discussed in here, right? You do not really need $25,000 to start trading futures. You really do not need $10,000 to start trading futures. Depending on your brokerage, you can start trading futures with as little as $500. As said, each broker has its own restrictions, but in general, the margin requirements are very, very low. Now, let's also quickly summarize the cons of trading futures. And the biggest con in general is the commissions and exchange costs, right? Now, again, this very much depends on the brokerage that you select. There are some brokerage which actually provide low commission structures. So be careful selecting your broker and do check the commission and exchange cost structure before opening an account. And the second major con is the risk management, but I think that is in general when it comes to trading. So if you're a day trader, you should not really swing your positions overnight. Right? So let's say if you go long or go short on futures and you swing your position overnight, anything can happen in the overnight session. Let's say you do take a position and something happens overnight. The market could open with a heavy gap up or heavy gap down, and that is going to create some issues, right? So be careful when it comes to risk management. As said, this is rather a general factor in trading, not specifically related to day trading futures, but just be careful when it comes to swinging positions and manage your risk accordingly. Now, last point that we quickly are going to cover in this video is a margin requirement. As said, this refers to what exactly you need in order to start trading futures. Every brokerage has its own margin requirement. When trading futures, you will get to know these three major terms: intraday initial, intraday maintenance, and overnight margin. What exactly they mean? Let's quickly have a look at them. Intraday initial means the amount of money that you need to initiate a position. Intraday maintenance means the amount of money that you need to have in your trading account at all the time that you're holding your position. And the last point is the overnight margin. That is the amount of money that you need to have in your account in case you are swinging overnight. Now, these three are very, very important terms, and you will see these terms whenever you open a brokerage account. So with that being said, let's quickly look at what do you need to get started. As said earlier, the process is very, very simple. You look for a broker firm, right? Whatever brokerage that you want to use, you apply, you open an account. Once your account is approved, once your account is opened, then you deposit money in your account. As said earlier, there is no PDT rule. There is no such requirement. You do not need to have 25 grand in your trading account. If you are choosing the right broker, sometimes you need as little as 500 to start trading the micro contracts. Once the money is deposited, then you start trading. So to sum up everything, today we discussed that futures trading provide traders with the possibility to earn a lot of money, but at the same time, you can limit your risk exposure. You do not have to worry about your premiums, and you do not have to worry about margin requirements as well. You can go long or short depending on your trade conviction, depending on your trading setup, without having to worry about the margin requirements, without having to worry about PDT rules and all those elements. And what do you need to start trading futures? Open an account, deposit money, and take it from there. So I hope this video provided you guys some value. If you guys like this video, go ahead, hit the like and subscribe button, and I will see you guys in the next video.